Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's happening in investment markets right now and what to look out for in the days and weeks ahead. Now, in the last week, we've had not a lot going on in investment markets. We've had the pattern we did established at the beginning of November starting to continue. So we saw the US stock market in particular grind higher, starting to set more and more new all-time highs. So we broke above the 3,100 level and we're pushing above that now. Now what is interesting, we're seeing a lot of the sector rotations. Now for 80/20 investor members this week, I talk a lot about the value in different sectors, the unloved sectors that are starting to perform better than they had done previously. They've been left behind. So those things most exposed to the US economy. So 80/20 investor members see explicitly where those value opportunities lie. But those sectors have started to do well. But then we get rotations back again into defensives, very much dependent on the news flow surrounding the US-China trade war. Now, the optimism we've seen in US stock markets hasn't necessarily been reflected everywhere else. The bond market has seen a rally in bonds. So that means that bonds have started to perform better. They had sold off, but they've started to perform a little bit better. We saw the US 10-year Treasury yield fall from 1.9 down to about 1.7. So we've seen some money flow out of equities, maybe some profit taking, maybe some fear over the headlines that the US trade deal with China might not be completed this year, has encouraged people to move into a little bit more safety. We've also seen equities in Europe pull back slightly. So in the UK in particular, we've seen the FTSE 100 go from around 7,400 down to about 7,200. So not all is going great. It just seems like that way if you look at the S&P 500 in America. Now, interestingly, if you look at the sector level in the US market, a lot of the heavy lifting this year has been done by two companies, Apple and Microsoft. And we're looking at tech stocks having probably their best year in almost a decade. So that's including some of those sell-offs and wobbles we've seen during the year. And with such heavy lifting happening by a very narrow number of stocks, then there are concerns forming over the breadth of the rally. So if the number of stocks enjoying new highs throughout a period of time, if that starts to fall, that's a sign that maybe the rally is running out of steam. So what we want to see in the coming days and weeks, to see that trend of a narrowing in breadth to stop. We want to see more of those cyclical stocks start to enjoy more of the rally. We want to see more stocks more widely enjoying the rally. Otherwise, if we keep setting some new lows on some of these stocks, so lower highs, then it could mean that we could see something unravel. Now, the other thing to bear in mind is the VIX, the fear index in the market. So that has been hitting lows. We've had it falling down towards around about 12. Now, that is very low. A couple of years ago, we got down to single digit numbers. That was before January 2018, when we had a very complacent market, which then the VIX exploded upwards and we had a violent sell-off. Now, the VIX is still pushing towards those levels. Given what's going on in the macro themes out there, so trade wars and Brexit and slowing global growth, then is the market being complacent? And 80/20 investor members this week will get a whole piece around this complacency or potential complacency in the marketplace. Now, if it is complacency, then don't be surprised if we're setting up for a little bit of a pullback into the end of the year. It's not guaranteed, but we've seen patterns like this before. It's just something to bear in mind, because we might see a pullback, we might not. But of course, the buy the dip mentality is still very much in charge in equity markets. So any pullback we see could be bought very quickly, as has happened in the last decade, especially with the US Federal Reserve pumping more money into the financial markets, which is finding its way, as usual, into stocks. So we've still got a lot of uncertainty in the markets. We've got Brexit, the UK political scene. So we've got the UK election coming up. Of course, we've got the US-China trade war. We're getting conflicting headlines almost hourly on whether there's going to be a deal or not. And of course, we've still got the fundamentals slowing. So corporate profits have been falling, and we've got global growth seemingly to slow, especially in China. So in the coming weeks, expect volatility to pick up, just because by almost a law of averages, mean reversion, it's unlikely that the VIX will stay this low, and we're going to see probably a pickup in volatility. So that is it for this week on Damien's Midweek Markets. You can get in touch with me as ever via email, damien@moneytothemasses.com, via Twitter, money to the masses with a number 2, and of course you should subscribe to our YouTube channel.